Finance Minister Brian Lenihan is here with me now in studio. Thank you, Mr. Minister, for coming in.
Thank you.
This is a heck of a charge to have in addressing investors' concerns right now. But tell me, I mean, Ireland has the worst budget deficit in the Euro region. You've had to nationalize Anglo-Irish. Allied Irish had to take a majority stake. Can you stabilize the system without going to the IMF or another body and asking for help?
Well, absolutely, because at the first point you have to do is look at the real Irish economy. We are exporting. We're not in a balance of payments deficit position. Our exports have retained a lot of their strength throughout this recession. We're emerging from recession with strong export performance, but we do have real fiscal and banking problems to address. We are addressing them, and we have a plan to address them. On the banking, as you know,
despite the stronger euro there and then the contraction that did just happen with the Irish GDP.
We had a big contraction last year in 2009. We contracted by 10% in GNP terms in 1 year. We've got it back to zero this year, and that's quite a turnaround to go from 10% to zero in the space of 1 year. We have to take the necessary measures on the banking side. We've done that. We've differentiated the different institutions. We've made it clear what the cost is going to be, and we're averaging that cost over a 10-year period. On the other front, on the budgetary front, clearly we have a big challenge there because government receipts are lagging well behind government expenditures. We've already done a correction of 7.5% of our GDP, and we're now about to publish in November a 4-year plan which will outline how we can get growth and how we can correct our budget over a 4-year period. And the first instalment of that will be in the December budget.
A lot of anticipation about that budget. I know you were at the IMF meetings over this past weekend. You were quoted there in the press as saying that there will be above €3 billion in spending cuts and tax increases for 2011. Where is that money coming from?
Well, again, you have to look at your expenditure base, obviously, and decide what expenditures can be reduced. We've already reduced public service pay in Ireland by nearly 14% on average. We're much bigger, of course, for ministers and much less for those in clerical and other positions in the public services. Likewise, we've looked at our welfare bill, we have to look at our pensions bill, we have to look right across our capital investment projects. All of these areas have to be looked at. They're on the table, and what we're going to do is demonstrate over a 4-year period how we can make those adjustments, because obviously an adjustment on this scale can't be done in 1 year. It will be averaged over 4 years, combined with a strategy for growth, looking at the supply side in the different sectors. We've retained a robust export sector. We have to continue to develop our traditional sectors as well, and we can do that. We have a strong underlying economic base. We had a big property bubble earlier in this decade, and that has had a big impact on the economy. We're working out the consequences of that.
You're emphasizing their cuts. Does that mean that tax increases, how big of a portion are they going to be in helping to close this?
Tax will have to play some part in terms of base broadening, increasing the numbers who are in the tax base. At present, a lot of earners are not in the income tax base in Ireland, but I do want to make it clear that the corporation tax of 12.5% will stay intact. That is our industrial investment policy, and we're sticking with that.
So you will not move that higher than 12.5%?
No, we won't. No, because
do you fear corporate flight if that were to happen?
Well, that's the risk, and candidly, we have decided to make this the cornerstone of our industrial investment strategy. We have a lot of companies in ICT, in pharmaceuticals, medical devices, banking services, making a tremendous contribution to the economy. We want to encourage that investment, not discourage it.